In 1928, the lights were bright and the noise was happy. Stocks rose like a tide before a storm. Newspapers called it the new era. People didn't whisper. They shouted, "Endless growth, permanent prosperity. Why not us?" Then October 1929 arrived. One day, one panic, one shattering sound that seemed to split the century in half. Fortunes gone, futures erased. A decade of pain. Pause and think about that. Nearly 100 years later, the rhythm sounds familiar. Rising markets, clean charts, clever headlines, a confidence so thick you can lean on it until it gives way. You've heard the line, history doesn't repeat, but it rhymes. Listen closely. The rhyme scheme is perfect. The financial mechanics, the psychology, the celebration of numbers that don't ask questions. And if you think this couldn't happen again, think again. Because in 2024, we've rebuilt the same scaffolding. We've climbed higher. We've looked down less. Comment below if you see the pattern. To see what's coming, we have to go back to where the spell was cast, when optimism turned into a promise, and a promise turned into a trap. After World War I, America stepped onto the stage with a new voice. Factories hummed. Cities swelled. Roads stretched like veins across a growing body. Cars, radios, refrigerators. For the first time, ordinary families felt rich because for the first time they were. Consumerism became culture. The store window became a mirror. And then Wall Street put out a welcome mat. Taxi drivers bought shares. Teachers bought shares. Shopkeepers bought shares between customers. Investing wasn't a privilege anymore. It was participation in destiny. They called it the new era. The era where cycles were conquered and prosperity was permanent. Who wants caution when the future is science? Nearly a century later, the names are different, but the spell is the same. AI, automation, the digital bloodstream running through everything. We live stream our dreams and algorithm our risks. We whisper, we've outsmarted the cycle. We tell ourselves, volatility is temporary. Innovation is forever. But innovation doesn't cancel gravity. It just takes you higher before the fall. This is how illusions work. They borrow truth to sell fantasy. Subscribe if you want to understand what's next. Now let's lift the hood. Let's look at the engine that made the miracle move, then and now. In 1928, the magic trick had a name, margin, 10% down, 90% borrowed. With $1,000, you could control $10,000 of stock. A gentle breeze in your favor doubled your money. A small gust against you erased your life. Leverage didn't just amplify gains, it accelerated belief. Borrowed money pushed prices up. Rising prices justified more borrowing. A loop, a chant, a mania sung in numbers. By 1929, margin debt had exploded. Billions upon billions in borrowed confidence. The market stopped being a weighing machine. It became a mirror. People didn't see value. They saw themselves, smarter, richer, invincible. Pause and think about that. Fast forward to 2024. We don't call it the same thing, but we play the same game. Record margin levels, securities-based loans against portfolios, options for leverage, leverage on options, crypto with multipliers that make gravity look optional, real estate stacked with adjustable promises, and a culture that calls risk alpha and fear FUD. The instruments evolved. The psychology didn't. Everyone believes they've cracked the code, that the Fed is a safety net. That data is destiny. That drawdowns are glitches on the road to guaranteed riches. But risk doesn't vanish. It hides. It waits for a change in weather, rates, liquidity, sentiment, then steps out of the shadow and asks for payment. Leverage is a liar with perfect timing. It tells you you're rich on the way up. It tells you you're ruined on the way down. And it always tells the truth, eventually. So ask yourself, are prices rising because companies are worth more, or because borrowed dollars are chasing the same shares? Comment below if you've seen this loop up close. Technology adds fuel to this fire. Real breakthroughs, twisted into financial prophecy. Let's talk about how innovation becomes a religion. Every great bubble begins with something real. In the 1920s, that truth was electricity, radio, the assembly line. Factories transformed overnight. Productivity soared. The world felt new. And investors? They mistook innovation for invincibility. They called it the new economy. They believed America had entered a permanent boom where progress itself was profit. But the story was never about electricity. It was about belief. People believed machines could outwork risk, that human ingenuity had rewritten the rules. Nearly a century later, we're singing the same hymn, just with new instruments. Artificial intelligence, automation, robotics, cloud computing. We tell ourselves these aren't fads, they're revolutions. And that's true. But revolutions don't eliminate gravity, they accelerate it. Tech companies post record profits. Stocks soar. Pundits preach about a new era. Sound familiar? History's trick is repetition with better marketing. In 1928, radio connected homes. In 2024, AI connects minds. Both times the tools were real, and both times the faith built around them became fantasy. Pause for a moment. When you hear someone say, "This time is different," remember, That's what they said the year before everything fell apart. But bubbles never burst from euphoria alone. They collapse because of what's hidden underneath, the quiet cracks no one wants to see. On the surface, 1928 looked unstoppable. Profits up, jobs steady, cities glowing. But underneath, the foundation was already splitting, corporate debt was surging. Banks lent to each other like gamblers swapping chips. Investment trusts bought shares of one another in endless circles. It looked sophisticated. It was fragile, and wealth? It was stacking at the top. The rich multiplied their fortunes through speculation. The working class watched prices climb faster than paychecks. Inequality stretched like a rubber band ready to snap. Now look at 2024. Corporate debt again at record highs. But this time, it's not for factories or innovation. It's for stock buybacks. CEOs propping up share prices to hit bonuses. Meanwhile, the wealth gap has blown past 1929 levels. The top 1% own more than entire nations. The middle class borrows to survive. Credit cards, car loans, student debt. While the elite borrow to speculate. We call it prosperity. But it's leverage dressed as growth. When money is cheap, everyone looks brilliant. When money tightens, only the honest balance sheets survive. And here's the quiet truth. Our prosperity isn't earned. It's engineered. But engineering has limits. This is the calm before the storm. A system inflated not by productivity, but by confidence. And confidence always disappears first. Which brings us to the architects of both eras. The ones who tried to save the system. And instead, built the trap. In the 1920s, the Federal Reserve had a dilemma. Britain was struggling to stay on the gold standard, so the Fed kept U.S. interest rates low to help. Cheap money poured into the market. Investors borrowed more. Prices soared, and speculation turned from habit to religion. Then, in 1928, the Fed panicked. Rates rose, the air got thinner, and the entire house of cards began to shake. Nearly 100 years later, central banks repeated the ritual, only on a global scale. After 2008, they printed trillions. Zero interest rates. Quantitative easing. Stimulus after stimulus. Money became free, and free money never sits idle. It chased returns. Into stocks, into real estate, into crypto, into everything. We called it the everything rally, but in truth it was the everything bubble. Now inflation is back and the Fed is tightening again. The same medicine that saved the patient is killing it. Tech stocks crash. Commercial real estate buckles. Banks start whispering about liquidity issues. It's 1928 all over again, just with smartphones. The economy's addicted to cheap money. Raise rates and withdrawal begins. Keep them low and the addiction deepens. Either way, the ending's the same. And this time, the tremors won't stop at Wall Street. They'll ripple through every market, every nation, every screen. Because in the 21st century, crashes don't spread through ships and telegrams. They spread through code. In 1929, the crash began in New York, but it took months to travel across oceans, through telegrams, through trade routes, through the slow machinery of global finance. Today, it would take seconds. We've wired the entire planet together, trillions of dollars moving at the speed of light. Stocks, currencies, bonds, derivatives, all connected through code. A glitch in one corner can ripple through another before anyone even hits refresh. It's not a domino line anymore. It's a spider web, and every strand is trembling. Consider this. The global derivatives market now exceeds $600 trillion. That's nearly 7 times the size of the entire world economy. These contracts were supposed to spread risk. Instead, they've concentrated it into a handful of giant financial institutions, each one too big to fail and too fragile to survive alone. When one domino falls, it won't stop at the border. It'll race through Tokyo, Frankfurt, New York, and Shanghai. A chain reaction measured in milliseconds. The next crash won't move through time. It'll move through fiber optics. But for all the math and machines, every collapse starts with something older than finance itself: belief. Because the most dangerous leverage isn't financial. It's psychological. Every bubble is built on faith. Faith that numbers will rise. Faith that the future will look like the past, only better. In 1928, it was gospel truth. Stocks always go up. Taxi drivers gave stock tips. Shoe shiners speculated on margin. Families pulled savings to invest in America. It wasn't a market, it was a movement. Today, it's déjà vu in digital form. We call it long-term investing. We quote Warren Buffett between memes and market charts. We tell ourselves, time in the market beats timing the market. And sure, over decades, that's mostly true, until it isn't. Because the market doesn't care about your retirement plan. It doesn't care about your 401k or your index fund. For the first time in history, Nearly every American's future depends on markets never falling. And that's the trap. Because when everyone believes the same thing, risk hides where no one's looking. Faith has replaced analysis. Optimism has replaced caution. And when belief meets reality, belief always breaks first. The question isn't if belief will break. It's how fast and how far the cracks will spread once it does. Crashes don't start loud. They start quiet. In boardrooms and balance sheets. In the places where confidence slips first. A few defaults. A few missed payments. A few nervous fund managers pulling back just a little. Then the silence breaks. In 1929, it was margin calls and bank runs. In 2024, it could be a bond market seizure, a real estate implosion, a currency shock. The spark doesn't matter. The structure is already soaked in gasoline. Global debt is now higher than at any point in recorded history. Government, corporate, consumer, all leveraged to the limit. Central banks can't raise rates without breaking the system. They can't cut them without reigniting inflation. Every lever they pull snaps another wire. The foundation is gone. The anchors, gold, fiscal discipline, restraint, are relics. Today, currencies are backed by nothing but trust. And trust is a currency that evaporates in a storm. When confidence breaks, it won't be gradual. It will be instant. Markets crashing in hours, not days. Panic spreading faster than policy can react. The ingredients of 1929 are all here. Only this time, the recipe feeds the entire planet. And yet, even with all this, most people still believe they're safe. Because every generation thinks it's different, and every generation is wrong. Every financial disaster begins with arrogance and ends with humility. In 1929, they said the new era. In 2008, it was too big to fail. In 2024, it's the everything bubble. Different names, same delusion. We always believe the rules have changed. That human genius has tamed chaos. That our models, our algorithms, our policies are smarter than history. But history doesn't negotiate. It doesn't care how advanced we think we are. It humbles those who ignore it. It erases those who mock it. Pause and think about that. Every warning sign we see today, margin debt, corporate leverage, inequality, speculative mania, existed a century ago. We studied it. We taught it in schools. And then we built the same machine again, just bigger and faster. The lesson isn't in the crash. It's in the arrogance before it. So the question isn't whether this ends. It's what you'll do before it does. The crash is coming. Maybe not today, maybe not tomorrow. But soon enough that ignoring it is a luxury few can afford. Debt is unsustainable. Speculation is rampant. And faith, the one resource that holds everything together, is cracking. Most people won't see it until it's too late. They'll say it's temporary. They'll blame politics or the Fed or the news, but you've seen the pattern. You know how this story ends. So what will you do with that knowledge? Will you ride the wave until it breaks? Or prepare before the tide goes out? If this opened your eyes, subscribe, because awareness is your first defense. And remember, history doesn't repeat, but it always collects its debt.